These are nearly 100,000 reverse mortgage loans that failed, financial products sold to seniors as a way to stay in their homes that ended up taking those homes away. What follows covers what reverse mortgages are, how they were sold, why they went wrong, and what changed because of it. A reverse mortgage lets homeowners age 62 or older convert part of their home equity into cash without making monthly mortgage payments. And instead of the homeowner paying the lender pays the homeowner. The loan only comes due when the borrower dies, sells the home, moves out permanently, or violates the loan terms. Sounds simple, and that was part of the problem. Every single month, the loan balance grows because unpaid interest compounds and gets added to what the borrower owes. Fees alone can run between 2% and 6% of the home's value, which on a $500,000 home works out to an estimated $17,000 in closing costs before a single dollar of equity gets touched. The vast majority of reverse mortgages in the U.S. are government-backed loans called HECMs, short for Home Equity Conversion Mortgages, insured by the Federal Housing Administration. And here's the thing most borrowers never learned: that FHA insurance protects the lender, not the borrower. Congress made the HECM program permanent in 1998, and by fiscal year 2009, the industry had hit an all-time record of 114,692 loans endorsed in a single year. The market was expanding fast, and with that expansion came a very specific kind of sales strategy. Turn on a television during the 2010s and you'd find familiar faces selling reverse mortgages directly to the generation that trusted them. Tom Selleck, Henry Winkler, Fred Thompson, Robert Wagner, Pat Boone. American Advisors Group, the dominant lender for years, watched its revenue climb from $63 million in 2012 to $216 million in 2016. The same year Selleck became their national spokesman. In one commercial, Selleck told viewers he wouldn't be there if he thought reverse mortgages took advantage of any American senior or were some way to take their home. December 2016 told a different story. That month, the Consumer Financial Protection Bureau fined 3 firms, American Advisors Group, Reverse Mortgage Solutions, and Aegean Financial, a combined $790,000 for deceptive advertising, because those companies had promised seniors they would never face foreclosure or lose their home. By 2021, AEG faced another round of penalties, this time over $1 million, for violating that consent order and for marketing the product using inflated home estimates. A legal aid attorney named Karen Merrill Chaps put it plainly: there's a lot of salesmanship that goes on with reverse mortgages. Seniors are told they are never going to have to make a payment. And that sounds very good. And then several years down the road, you have a problem. That problem became a documented catastrophe. A year-long USA Today investigation found nearly 100,000 reverse mortgages had failed across the country, and the GAO's own data showed HECM terminations due to borrower default climbing from 2% in fiscal year 2014 to 18% in fiscal year 2018. More than 18% of reverse mortgage loans taken out between 2009 and June 2016 were expected to go into default over unpaid taxes and insurance, compared with less than 3% of traditionally insured mortgages considered seriously delinquent in the same period. Several distinct paths led seniors to foreclosure, and many of them traced back to how the product was sold. Seniors who fell behind on property taxes or homeowners insurance triggered foreclosure, often because they had been told or simply assumed the lender handled those costs, which it doesn't. Borrowers who took their equity as a lump sum were especially exposed, and by the peak years, lump sum payments had grown to account for 70% of all HECMs. Borrowers who drew 80% or more upfront were twice as likely to default on taxes and insurance as those who drew 60%, and 4 times as likely as borrowers who drew only 40%. And then there were the surviving spouses. Brokers sometimes advised couples to remove the younger spouse from the title entirely, because doing so qualified the older borrower for a larger loan amount, which meant more commission. When the borrowing spouse died, the surviving spouse had no legal standing, no protection, and no option except to repay the full balance immediately or leave the home. ARP sued HUD over this practice in 2012, in a case called Bennett versus Donovan, and a federal court ruled in favor of the surviving spouses the following year. Reforms came, but only for loans issued after August 4, 2014, leaving everyone before that date to navigate a system that had already failed them. Odette Williamson, A staff attorney at the National Consumer Law Center described what that moment felt like. Imagine you've just lost your spouse. You've been with him or her for decades, and you've never handled the finances. It's just not enough time for a non-borrowing spouse to meaningfully take advantage of saving the home. The foreclosure crisis did not land evenly across the country. The USA Today investigation found that in zip codes where most residents earned less than $40,000 a year, reverse mortgage foreclosure rates ran 6 times higher in black neighborhoods than in white ones, with the hardest-hit cities including Chicago, Baltimore, Miami, Detroit, Philadelphia, and Jacksonville, Florida. In some of those neighborhoods, brokers had specifically targeted seniors by leaving door hangers advertising tax-free benefits and seeking out homes in need of repairs, focusing on communities least likely to seek independent financial advice. Philadelphia City Council member Sherelle Parker called it what it was: a crisis, one serious enough that the city eventually secured a $40 million fund to help preserve home loans. In Jacksonville, legal aid attorney Jim Kowalski described servicers pursuing foreclosure over debts so small that, as he put it, when a lawyer walks up and sees 27 cents, they should fold up their tent. That's not a hypothetical. One senior got sued by a servicer over a 27-cent discrepancy, which then triggered a foreclosure proceeding. Another received his foreclosure notice for alleged non-occupancy at the very home the lender claimed he wasn't living in. The government's response moved in stages, and none of it came quickly enough for the people already losing their homes. President Obama signed the Reverse Mortgage Stabilization Act in 2013, capping first-year borrowing at 60% of the principal limit and requiring financial assessments. New protections for non-borrowing spouses followed in 2014 and 2015. In October 2017, HUD reduced the average borrowing limit from 64% to 58% of home value, cutting the risk exposure on new loans. But a 2019 GAO report found that FHA had conducted no on-site reviews of HECM servicers since fiscal year 2013, 6 years of effectively no oversight. As of 2019, only about 22% of distressed borrowers had received repayment plan options that could have prevented foreclosure, which meant the other 78% were left without a lifeline. The GAO also disclosed something that rarely made headlines. FHA's own data doesn't capture the reason for roughly 30% of HECM terminations, which means regulators genuinely don't know why nearly a third of these loans end. Reverse mortgages are not inherently fraudulent, and that distinction matters. A 2018 survey published in the Journals of Gerontology found that HECM borrowers reported higher financial and housing satisfaction 3 to 5 years after getting a loan compared to those who completed counseling but opted out. 1/3 of U.S. households have nothing saved for retirement, and the average savings among those who do had reached only $73,200. Not enough to sustain most retirements. For seniors sitting on home equity with no other options, a reverse mortgage can genuinely fill that gap. But the product's complexity got consistently undersold to the people buying it. Required counseling before obtaining a HECM could be completed in as little as a 20-minute phone call, a standard widely criticized as inadequate for a financial instrument this layered. Major banks, including Wells Fargo and Bank of America, eventually walked away from the market entirely. And the program that began in 1961 with a single loan designed to help a widow stay in her home after her husband's death had, decades later, displaced thousands of surviving spouses from theirs. By fiscal year 2024, HECM volume had fallen to 26,521 loans, its lowest point in years, driven largely by high interest rates reducing how much seniors can borrow. The reforms are more extensive now, and the market is smaller. None of that rewound what had already happened. The very first reverse mortgage in American history was written to help someone remain in her home, and for nearly 100,000 families, the product that followed did the opposite.